You know, the big question, you and I were talking about it, is the fact that there's so much uncertainty on how much spreads have left to widen. How do you have a barometer of how far that can go, and how are you preparing for further widening here?
Yeah, no, thanks for having me. There is definitely a bunch of scenarios where spreads go wider, where yields go wider, particularly if we get closer to a recessionary environment, which is not our base case. However, I don't think enough people are spending time talking about, one, the credit quality of the high yield market, and then two, where that average dollar price of the high yield market is. Well, and why I bring that up is just because, look, it's one of the lowest dollar price we've seen, and it's one of the highest quality high yield market we've seen, which should dampen and put a floor on spreads and yields versus historical levels.
Well, if you believe that, and if you believe that investors are maybe throwing the baby out with the bathwater a little bit here, then how much can you really dive in, knowing that you guys were some of the biggest buyers in the heat of 2020? You don't have the Fed's backing necessarily this time around.
No, absolutely, and we're definitely in the walk, don't run category. And we're definitely in a period where we're going to have a ton of volatility for an extended period of time. But there is a lot of interesting opportunities, and the ability to reposition and have more tools in your toolkit to where you can adapt and be flexible and be nimble, I think that's how you're going to win in this credit market.
Talk to us about the composition of the high yield bond market. You were talking about the health of corporate balance sheets. We've talked a lot about energy, the composition of energy within the high yield space, energy on a tear. How is generally sort of the health and cash flow of these companies?
Look, in the high yield bond market, it's very healthy. These are bigger businesses, larger businesses. It's diversified. Over 50% is double B. A lot of the leverage buyouts have migrated to the syndicated loan market, and that's where we're seeing increasing risk, not necessarily in the high yield bond market. So I'm not so concerned about a spike of defaults or a big loss ratios coming out of the high yield market. And these companies are handling this inflation, although it's extending and exacerbated by what's going on in the Ukraine and in China with COVID, but they're handling this inflation extremely well.
How are investors handling, how are the markets handling this environment at the moment, Chris? Because we had the Federal Reserve warning about liquidity and their concerns there. Have you been seeing any liquidity concerns?
Look, I think on the underlying businesses, liquidity isn't a concern yet. I think there could be some extension in certain subsectors or sectors that are going to feel a little bit more pain from the supply chain and some of these wage inflations or cost inputs, particularly around commodities. Now, the underlying liquidity of the markets have dried up a little bit. And what you're seeing is the construct of the high yield market and the construct of the credit markets, which was really fueled by the globalization of really the economies, is creating a lot of volatility. And what I mean by that is you have 40% of the high yield market in daily liquidity vehicles. You know, when they get outflows, they're forced sellers that day. And if you need to provide liquidity, and if you need liquidity and you can be that liquidity provider to those businesses and to those companies, there's a lot of value you can get out of that.
We've been talking about this a lot, this idea of forced selling. How much of that forced selling that you're seeing in some of those more liquid vehicles adding pressure to the market?
It's adding a lot of pressure. It's not just the daily liquidity vehicles, but you just touched on it on currencies. Given the globalization of the market, a lot of flows have come in from areas like Japan or UK pensions. And when you set up those vehicles, you're taking in yen or you're taking in sterling and you hedge that back. And so what you're seeing right now is a lot of assets being sold to meet margin calls on the FX hedges.
That's really interesting, margin calls, because we have this constant question here about the cost of credit. And if you are a leveraged investor right now, cost of leverage is going up. So do you think that some of the selling can just get worse, just given that people can't afford to pay their lenders back as easily?
I'm not that worried, just given the fundamentals have been fairly good and we're going through Q1 earnings or the tail end of Q1 earnings. And what we're seeing across our 1,400 credits across our global business is, close to double-digit EBITDA growth. Now, slowing will occur. It's just natural. It has to. And it's going to be healthy. So I'm not worried about interest coverage on the broadly syndicated large businesses. Where I'm more concerned about that is on the smaller middle market businesses, the sub 30 million EBITDA. They have less ways to win. They're more concentrated. A lot of times their management teams aren't as sophisticated. They don't have access to as many markets to raise liquidity. That's where I think you'll see a little bit more spike in defaults.
How much of your time is spent thinking about the moves of a Federal Reserve? It doesn't matter when you're thinking about the rate at which they are hiking and any dislocation in the market created by an active QT sell-off of the balance sheet?
Yeah, we're spending a lot of time thinking about that. We're spending a lot of time globally collaborating with all the different parts of KKR to make sure we get a better purview of what's going on globally in the market so we can assess risk, reward, and relative value. It's super important. And I think that's where the key to the success of where I think we have a competitive advantage at KKR is just being able to have flexible capital, being that liquidity provider when others are looking for liquidity, being able to pivot from the public markets to the private markets, stepping in on capital solutions ideas when the equity market's not there, and backing growth companies that still need growth capital to fuel their business plans.
Chris, just lastly, public and private markets. Before there was plenty of talk, the likes of Cathie Wood saying there's a real dislocation between the two. Are we seeing less of a dislocation? Are we seeing, valuations pop in both areas to the same extent?
Yeah, I mean, look at the volatility. You're not seeing volatility in the private credit markets right now because you're not seeing that forced selling and fundamentals are still good. And we like private credit. We like private credit even today, particularly as you get a shift from large syndicated markets that the public markets aren't available for them now, moving into the private credit markets. I'd much rather lend on a private credit basis to a 400 million EBITDA business than a 30 million EBITDA business. Mm-hmm. And so we actually are leaning in some cases, obviously the right sector, the right company in the private credit market, and even on the subordinated part of the capital structure, because right now you're getting call protection, floating rate, double-digit returns, and real multiple money in that subordinated part of the capital structure on the large-scale businesses.